Welcome back to Fast Money. A major sell-off hitting Wall Street today after the bond market flashed a big warning sign that a recession could be on the way. The yield curve inverting for the first time since 2007. Our next guest says there's an even bigger problem brewing in bond land, though. Let's bring in Mark Yusko, CEO of Morgan Creek Capital Management. Mark, great to see you. What is this bigger problem in the bond market?
Yeah, look, I think we've got the biggest bond bubble we've ever seen in history. And it's starting to show signs of deterioration. And, we've talked about this really since last fall, where the markets are playing out very similar to 2000, 2001, 2002. And in 2001, we had the mild recession, and it was 2002 where you had the bond bubble explode with Enron and WorldCom. And I think the same thing's starting to happen here. You've got so many corporate companies that are really over-leveraged. They've been issuing debt to buy back stock. And that's finally coming, that they have to pay the piper now that growth is slowing and profits are falling.
So when you're talking about a bubble in the bond market, you're talking specifically about corporates, or are you also including the 10-year on this?
Definitely governments. Look around the world. German bunds are down at negative 0.6. Japanese bonds are negative. Swiss bond market's negative out to 30 years. Who could possibly believe that? And it's just because the marginal buyer, the buyer of last resort, the ECB, is doing non-economic things. And so U.S. rates are now following that. And there's a lot of talk about this yield curve inversion. And one of the things that I think is very interesting is if short rates were where they should have been, right? If the Fed had raised them to equal the nominal GDP back 3 years ago, we'd be very inverted, and there'd be no question we're on the verge of recession.
Mark, it's Karen. Let me play devil's advocate on the corporate borrowing side. So rates have been very low for a long, long time. Corporations have had a long time to get their balance sheets in better shape. So how would you compare where they are now to that '02 that you talked about there's some widespread fraud? Maybe it wouldn't shock anyone to have fraud, but that seemed more of a catalyst to me than it would be this time around.
Well, I think you're absolutely right, Karen, that there were sectors where there was real problems, telecom in particular. But look at certain industries, you're starting to see a little stress in energy and lending, and look where oil prices are headed. There are a lot of very over-levered companies in the oil patch that could easily disappear. Their equity could disappear. The bondholders could be the new equity holders. There are companies like Tesla that the equity could disappear in a heartbeat, because they can't pay back the bondholders. So I agree with you that not the entire market, but I think there are certain companies, look at Pepsi and Coke, McDonald's, a lot of companies issuing a lot of debt to buy back stock. I think that was a bad idea as we go into a weaker economy.
Hey, Mark, it's Tim. So your forecast certainly is it gets nastier in 2020 based upon the debt dynamic. What's the next shoe to drop? You're a big emerging markets veteran. EM currencies have held in okay. Where do we go here?
Yeah, look, I have to say I was agreeing with your commentary earlier that, EM has really been much softer than I would have anticipated in the past few months. And, prices were cheap and they started to rally, and then they all of a sudden got cheaper. You look at something like Argentina, just the viciousness of that correction earlier this week. So I'm a little more nervous about how bad the global economy is. I mean, think about it. There are 15 economies around the world where the 30-year is below Fed funds in the U.S. So the global yield curve is very, very inverted. And that's usually not been a good sign historically.
Mark, one quick last question. That is, in recent weeks, a lot of people have been making a big thing about Bitcoin's run higher and the correlation it seemed to have been having with global turmoil. Things have seemed to have gotten worse, and Bitcoin also turned lower. So should we throw that narrative out the window, or at least table it?
Well, look, I've been saying for a long time that people who watch the daily price of Bitcoin are really missing the whole point, right? The whole idea of Bitcoin is it's a store of value. It's a chaos hedge, or schmuck insurance, as I like to call it. And what we need to think about is the long-term trend. Every year, the low is higher. The value of the network goes up. And so to worry about day-to-day valuations and prices really misses the major point, which is you want to own a piece of the network. You want to have 1, 2, 3, 5% of your net worth in this asset as a hedge against all the problems that we see in the fiat markets And in the equity markets, look, equities are very overvalued. Bonds are overvalued. It's tough to find an asset that is undervalued. The only one I can really find is volatility. And it has become less undervalued in the last couple of days.
Mark, thanks. Mark,
thank you, guys. Appreciate it.
Do you agree with his commentary about bubbles?
Yes. I mean, because when the genie's out of the bottle with this rate thing, I mean, rates are going to explode to the upside. That's a real concern. That's for a different show. But I'll say this just to play the other side. If there are real concerns out there, which there clearly are, they're not manifesting themselves in the HYG, the high yield ETF. Down less than 1% today. When that starts to crater, you get worried. It hasn't happened yet. So at least for now, high yield might be telling you a different story.